Good afternoon, everyone, and good morning to those of you joining us on the West Coast today. Siegel Rogers Casey would like to welcome you to today's webinar presentation. It is our first quarter 2013 Capital Market Review. Now I will introduce our speakers. First, we have Thomas Kachenko. He is an analyst. We have Ashley Lanquist, a senior analyst. We have Matthew Katz, associate director, and Nimisha Patel, also an associate director. And now I'll turn the call over to Nimisha.
Good afternoon, everyone, and thanks for joining us. We'll start by going over some of the macro indicators this quarter. So I'll start with GDP growth. Real GDP in the U.S. grew at an annualized rate of 2.5% in Q1. You can see this is the bar chart of both annualized GDP growth along with the year-over-year rolling percentage change. You can see that this was up quite a bit from Q4, which was up 0.4%. And positives for Q1 included greater consumer spending and increases in fixed investments, including in inventories, residential and non-residential areas. While non-residential growth was positive, it did slow significantly from the previous quarter, and some detractors to GDP were net exports and government spending, although government spending was less of a negative in Q1 than we saw in Q4. The savings rate, or the personal savings as a percentage of disposable income, declined from 4.7% to 2.6%. And it should be noted that this data is subject to revisions, which are coming out next week on the 30th. Now we'll take a quick look at CPI. So the headline CPI index was up 0.5% in Q1 and advanced 1.5% on a year-over-year basis. In March, gasoline, electricity, and fuel oil declined while the food index was unchanged. On a month-wise basis, CPI was flat for January, rose 7.7% in February, and declined just a bit, 0.2% in March. When you look at core CPI, which is the green line, this excludes food and energy prices. This rose 0.1% in March, bringing the year-over-year core CPI to 1.9%, which is slightly below the Fed's 2% target rate. Contributors for March included shelter, used cars and trucks, medical care, personal care, and airline fares, while some detractors included apparel, household furnishings, operations, and tobacco. Another metric that has not shown here is break-even inflation, which during Q1, the break-even rate was up 2.52%, which was very close to Q4's 2.45%. As I noted, the FOMC is keeping longer-term inflation and projects this not to be more than 0.5% above its 2% target. So you can see this is right in line. Something that ties into this that we'll touch on is the FOMC's policy of maintaining quantitative easing due to concerns of slowing growth. Speaking of the FOMC, this chart highlights target rates in the U.S., the Eurozone, and Japan, just to give you a highlight of what's going on. You can see not much has changed. At its March meeting, the FOMC announced that it would continue purchasing its agency mortgage-backed securities in the amount of $40 billion each month, as well as long-term treasuries in the amount of $45 billion a month. The FOMC also committed to maintaining its exceptionally low target range for the Fed funds rate between 0 to 0.25%, as long as unemployment stays above 6.5%. The ECB also continued to keep its target rate at 0.75%, while unemployment remains fragmented in the region, with particularly high unemployment in countries such as Greece, Spain, and Portugal, while countries such as Austria, Germany, Luxembourg, and Netherlands had low unemployment. They're still maintaining this policy. We can see every country now in Europe is in a recession except for Germany, and forecasted inflation is expected to decrease. It decreased to 1.8% in Q1 from 2.5% in Q4. Switching over to Japan, the Bank of Japan continued its low interest rate policies, maintaining rates at 0 to 0.1%. The inflation target was changed to 2% with a time horizon of 2 years. And we certainly heard a lot about Japan in the news. They're proceeding with their loosening monetary standards, and they intend to double the monetary base and the amount of Japanese government bonds and ETFs, and are also moving to more than double the average remainder maturity of Japanese government bond purchases. So we've obviously seen this effect in the Japanese stock market that has rallied quite a bit, which we'll touch on later in the equities section.